Okay, Assalamualaikum warahmatullahi wabarakatuh. Okay, I'm Puan Nur Aniza, Kuantaniam Bijuso. So today we're going to look into the statement of cash flow, okay, for part 3, okay, in the topic in basics of accounting. Okay, so this is part 3. Okay, so previously I have already introduced to you all on the what is actually the concept of the statement of cash flow, and in part 2 I have already highlighted about the types of activities that is reported under the statement of cash flow. Okay, so now we're going to look at the uh, types of activities individually. So for part 3 I'm going to touch only on the investing and financing activity first. Okay, so we're going to look at the investing activity first, okay, in the cash flow statement. Okay, so in the investing activities, the source of inflows and outflows comes from um, long-term assets. Okay, so it comes from long-term assets. So for inflows, it could be the selling of long-term productive asset and selling of any notes, okay, that the company has. And also it could involve selling investment in securities, or maybe if the company gives up loan to other third parties, okay, so if they collect loans, the principal on the loans, okay, so it is categorized under the investing activities. Okay, for the purpose of loans in under investing, it is only, okay, considered for the principal payment. Okay, so for any interest payment, it will be under interest revenue that comes under operating activities. So when we talk about investing activities, we're only looking at the collection of the principal, okay, the amount, okay, the initial amount borrowed, again, minus, okay, or subtracting the interest. Okay, so only the loans. Okay, then for outflows, it will involve making out loans to others. It means that the organization or the business lends to others, so they make loans to others, or if they purchase any long-term productive asset, okay, for usage in the operation of the organization, or if they purchase any long-term investment in securities, okay, or in bonds or debentures, and so forth. Okay. So cash flows from investing activities. Okay, so this relates to the acquisition and disposal of long-term tangible and intangible assets, and it also includes investment. Okay, so investment is that investment in other intangible asset, for instance, like securities. Okay, like bonds or debentures. Okay, and also any investment in other companies. Okay, so that is investing activities. Okay, so it relates to uh, giving and receiving. Okay, also giving and also receiving, okay, loans uh, from debtors. Okay. Okay, so not the current debtors but the long-term debtors. Okay, so investment in other companies. Okay, so cash flows from investing activities are actually an indication, of the expansion or downsizing of operating capacity. Hmm. Investing activities will include the following: purchase and sale of long-term asset, purchase of and sale of short-term investment. So here short-term investment means it's more than one year, okay, 1 to 3 years. Okay, so because investment is not categorized as long-term asset, okay, so we say that it's a short-term investment. Okay, so it's more than 1 years, but maybe below 5 years. Okay. Okay, so cash received paid are usually from short-term and long-term investment, debt securities, and from property, plant, and equipment. Okay, so when we receive payment, okay, usually payments, okay, so payments are usually for anything that is being okay, paid. The payment, you must see the payment whether it's an inflow or an outflow. Okay, so for inflows, it is actually the receipt of payment. Okay, and for outflow, it is actually payment being made. Okay, so for payments for newly acquired equipment, it means that the company will have to pay out to acquire equipment. Okay, so this is an outflow. Okay, for receipts from disposal of a building. Okay, so when a company dispose of a building or a long-term asset, usually they will receive money upon the disposal. Okay, and if they pay out for any new investment in a certain company, so this is actually like giving out a loan or making an investment in a company, so they are actually paying out money. So these are inflows. These are outflows. Okay, so cash inflows from investing activities normally arise from selling fixed asset, investment, and also intangible asset. Okay, so intangible asset are usually like securities. Okay, securities, for instance, like bond and debentures. And for cash outflows from investing activities, okay, normally including payments to acquire fixed asset, payments for any investment in another company, and also payment for intangible asset, okay, the securities. Okay, the more common inflows from investing activities will include receipt from sales of debt or equity securities, collecting principal on loans, and selling long-term productive asset. Okay. And the outflows are giving out loans or lending to other entities, purchasing any long-term productive asset, and purchasing debt or equity securities of other entities. Okay, so this is actually the summary of the activities that that involve inflows and outflows under investing activities. Okay, so usually for investment there are three areas. Okay, the long term asset, okay, debt securities, okay, that are not cash equivalent, and loans to others. Okay, so you have to understand which one will be inflows and which one will be outflows. Okay, so who will be the payer and who will be the receiver? Okay, so that is under the investing activities. Okay, so to determine the inflows and also outflows. Okay, so in the general rules for investing activities, okay, so increases in cash will stem from the sale of long-lived asset, collection of loans, and sale of investment. And decreases in cash, that is, this is cash outflow. Okay, so, sorry, this is wrong. Okay, so that is cash outflow. Okay, stem from purchases of long-lived asset, granting of loans to others, and purchase of investment. So, I think you better, after this, you correct it. Okay, so it's cash outflow. Okay, so this is inflow, this is outflow. Okay. Then, when you want to prepare for the investing activities, highlight, okay, or look up for sales and acquisition of long-term asset. Okay, understand what is happening. Okay, look at what involves cash. Okay, and if there's no indication of cash, so maybe you have to calculate, get to determine the amount of cash paid or cash received. Okay, analyze the accounts to determine the activity. And if gain or loss appears on the income statement, a long-term asset has been sold. Okay, so this is an indication in the income statement. Okay, information from the income statement whereby you can use it to understand whether there is actually any disposal or any purchase of long-term asset. Okay, so look if there is any gains or loss. Okay, so it's an indication that there is some movement, okay, for the long term asset. Okay. Okay, so when you want to calculate for cash flow from investing activities, there are actually formulas that you can use to determine, okay, the amount of cash received. Okay, so if for any cash received, okay, from sales of plant or asset, okay, you will start with looking at, if you are not given, okay, the amount of cash received, okay, you are not given, so you have to calculate, okay, based on the information given. So what do you have to look up? Okay, so you have to look out at the book value of asset sold. Okay, so usually it's stated in the uh in the transaction, okay, what is the book value, or the value before accumulated depreciation. Okay, because book value is actually the cost, the historical cost, or the cost of acquisition minus the accumulated depreciation of the asset. Okay, so that is book value. Okay, and then you have to look up. So usually this book value of asset sold can be derived or taken. The information can be taken from the balance sheet. Okay, but if it does not, if there is no balance sheet, okay, they it only state that this is the cost of the acquisition of the asset, and this is the accumulated depreciation. So you have to less the accumulated depreciation from the cost of acquisition of the asset. Okay, and then from the income statement, okay, you need to look at any information that is related on gain or loss. Okay, so if it is a gain, you have to add to the book value of assets sold. But if in the income statement said that it is a loss on sale, so it means that from the book value you have to minus uh, the amount of loss. Okay, so this will lead you to the amount of cash that will actually uh, received, that is actually received in the business organization. Okay, so that is for receipt. Now, when we look on payment, okay, so payment of asset, if there is any new acquisition of fixed asset. Okay, so how do you determine it? So usually we will use the balance sheet, okay, the comparative balance sheet. First of all, because you want to find the ending fixed asset net book value. Okay, so this could be taken from the previous balance sheet amount of the asset, okay, and then plus with the depreciation expense of the current year. Okay, so the current year, and then plus the book value of asset sold. Okay, so this one, the ending fixed asset, is actually a total of a few assets, and the depreciation expense is actually a total for a few expenses. Okay, so when okay, a new asset is acquired. Okay, so usually some old asset will be sold out. Okay, so you have to find whether there is any information on the book value of asset sold. Okay, so this will show in the transaction through the acquisition and the depreciation of that asset. Okay, so if there is the amount, okay, so you have to add the book value of asset sold, and then minus the ending fixed asset. So the ending fixed asset is the total net book value of the asset. Okay, so um, you add, okay, ending fixed asset with depreciation expense and book value of the asset sold, and minus the ending fixed asset, you will get the amount of acquisition. You could also use this formula. Okay, so it's the same. Okay, whereby you start with the ending cost of the fixed asset. Okay, and you plus the cost of asset sold and minus opening cost of the fixed asset. You will get the acquisition. Okay, so either one, okay, of the formula that you use, you will get the same amount, okay, of acquisition. Okay, so it depends on what is provided, okay, in the information about the transaction. Okay, so in investing activities, it is better that if you can memorize, okay, what is positive and what is negative. So positive means that you have to add, and negative is you have to less out, okay, or minus or subtract. Okay, so positive items are sale of planned asset. Okay, so these are inflows, sale of investment. They are not cash equivalents, so usually it's bond. Okay, and collections of loans receivable. Okay, so if you lend out money to debtors, so they are paying, they they paid, okay, they paid back the loans that you have given out to them. Okay, so collection of loans. So for negative items, it will involve any acquisition of planned assets. So you purchase of a new purchase of assets, purchases of investment that are not cash equivalent. So maybe it's a treasury stock or debt, a bond or debenture. Okay, so it depends. And if you make up loans to others, okay, so you give loans to other parties. Okay, so that are the negative items in investing. Okay, so this is the analysis of effects of investing transaction on cash. So you can see that there will be a difference. So look out for this indication whether the, okay, for purchase of asset, whether it's for cash or by issuing debt. Okay, so if it's by issuing debt, means that there is actually no exchange of there is no exchange of cash here. Okay, so actually um the asset is purchased through loan, okay, by issuing debt. Okay, so the purchase is made by loans from others. Okay, so there's no effect. Okay, so if you sell asset for cash, okay, the effect will be positive. And if purchase for investment of securities, okay, so negative. Okay, if you sell the investment of securities, okay, it's positive. Okay, making loan is negative, and collecting loan is positive. Okay. Now we move on to the financing activity. Okay. Under the cash flow, the next activities will be on the financing activity. Okay. So what is actually the financing activities? So these are activities that relates to changes in the size and composition of here contributed capital and financial debt of the company. So it means here it's related to the equity and also the long-term liability, okay, of the company. Okay, so financing activities will include the following. Okay, so any short and long-term borrowing, okay, notes and bonds and repayment. Okay, so if there are borrowings from uh, for instance, if you issue bonds out to get to acquire money, okay, so this is under financing activities. And if you issue or repurchase your own capital stock, okay, your shares, okay, either it's ordinary shares or preferred shares, okay, this is also included under financing activities. Okay, so for the inflows of financing activities, so it usually arise from issuing debt or equity securities. And for the outflows, okay, so this is from financing activities that will include usually paying cash dividend to the shareholders, repaying any debt, okay, for if you retire your bond, okay, and acquiring any treasury stock. Okay, so this is the cash flow from financing activities. Okay, so inflows of financing activities are from bank borrowings, other borrowings, okay, or any stock issuance. So other borrowings are, for instance, are from bond. Okay, outflows of financing activities, for instance, are from loan repayments to the bank, any stock that have that are sold by the shareholders that the company or the organization repurchase, and any dividend payments made to the shareholders. Okay, so this is actually the same. Okay. Okay, so examples of receipt from financing activities For instance, receipt from issuing new shares or bonds. So this is actually an inflow because the bonds are offered to uh, creditors. Okay, so when creditors or investors, okay, so when they take up the bonds, you will be receiving, okay, money into the organization. Or it could be receipt from new bank loan. Okay, so you have already applied for bank loan and now the money, the loan have been approved, so you are receiving the loan. Okay, so any payments for buyback of shares. So it means here that the organization buys back their shares in the market. Okay, so that is an outflow. And for repayments of loans, so when you service back or you furnish back the loan, so you repay money to the bank and any payments of interest and dividends. Okay, the more common inflows from financing activities include contribution from owners. Okay, so this is from equity and issuance of new equity or stock shares. Okay, issuing short and long term debt, okay, bonds and notes, okay, payable, and receipts from new bank loan or other borrowings. Okay, the more common outflows from financing activities include repaying loans to others, okay, redemption of long-term debt, okay, paying withdrawals of owners. Okay, so these are drawings, okay, from the owners. Okay, so they draw out money, so you have to pay out cash. Okay, paying dividends, okay, to shareholders if uh, this is a corporation. Okay, and purchasing treasury stock or requiring capital stock buyback. Okay, so this is actually the summary for the inflows and also outflows under the financing activities. Okay, so it's the same. Okay, it's the same. Okay, so the general rules for financing activities is that increases in cash. Okay, so this is mistype. Okay, stems the from increases in liabilities or paid up capital, and decreases in cash are cash outflows is stem from decreases in liabilities or paid up capital. Okay, so it's the same when you want to prepare for the financing activities. Look at what is related to equity and also to debts. Okay, changes in stock, debt, and also retained earning. Look up for any issuance of and payments on long-term notes payable, and look for issuances of stock and purchases of treasury stock, and then analyze accounts. Okay, to determine the activity. So you're looking at the differences between the comparative balance sheet, okay, between the previous year's balance sheet and also the current year balance sheet. Okay, so this is how you can calculate, okay, for receipts and issuance of stock. Okay, so you have to use the beginning notes payable. So this is usually from the balance sheet, okay, the amount of the previous year. Okay, and X is what you're going to look out, and then look out for any payment of note payable and look at the amount of ending note payable in the current balance sheet. Okay, so X is the amount that you want to find. Okay, so you use this formula to determine this one, X. Okay, cash receipt from issuance of not note payable. If there is stocks, okay, so start with the beginning stock and find the ending stock. Okay, so the difference will be the cash receipt from issuance of stock. And for treasury stock, it's the same as calculating for the organization shares. And for dividends, okay, so this is actually the formula for the statement of income, the retained earning. Okay, so start with beginning retained earning plus net income and minus dividend to get the retained earning. So what you're going to look out is actually the sentences in blue. This is the X. Okay. Okay, so that is what you're going to look at for receipt and also for payment. Okay, and these are for the notes payable. Okay, so actually the formula is the same. It's only the repetition. Okay, and repetition depending on what is being calculated. Okay, whether it's notes or bond payable. Okay. Positive items for financing activities are, for instance, like issuing stock, selling treasury stock, and borrowing money. And for negative items are payment of dividends, purchase of treasury stock, and payment of principal amounts of debt. Okay, so these are the analysis or effects of financing transaction. Okay, so where it involves cash, okay, inflows and outflows. Okay, the it will have an effect. But if you convert, okay, the payment or the receipt with a debt, okay, so it does not have any effect because there is no exchange of cash. Okay, so this is the part, okay, in the statement of cash flow on investing activities and also on financing activities. This is the extract. Okay, so here you can see the inflows and also the outflows. So the outflows are shown by the amount in the bracket. Okay, and the inflows, the amount that is not shown by the bracket. Okay, so acquisition of subsidiary, X net of cash. Okay, so it's an investment. Okay, and then there's the purchase of property, plant and equipment. Okay, so you're acquiring a fixed asset, so it's an outflow. Okay, then this is proceed from sale of equipment. Okay, so this is actually the money received after calculating, okay, the loss and also depreciation based on the net value. Okay, so this is actually the amount that is received, and this is interest received, okay, from um, investment activities and also dividends received from investment activities. Okay, so this is received from outside the company. Okay, and then for cash flow from financing activities. Okay, so these are actually inflows. Okay, dividend receive and interest receive are inflows, okay, from your investment activities. But if it requires any payments, so of any payment out to others, it's under operating. Okay, then cash flow from financing activities. Okay, so this will require, okay, for you to look into the equity and also on the long term debt. Okay, uh, so proceeds from issue of share capital, so it means that the company opens shares for to the public for them to acquire, okay, the shares, so it will increase the capital. Okay, so if there is any long term loans that have been approved, okay, so you are receiving the long term loans, so this is a positive side for financing activities. But if there is any repayment of any borrowings, okay, so this is a negative side, okay, outflow. And if any dividends are paid to the existing shareholders, okay, so this is also an outflow. Okay, so you have to total up, okay, for the inflows and outflows for each activity to get the net cash used for that activities. Okay, so for the net increase in cash and cash equivalent, this is actually totaling up, okay, all the three activities, the net cash use for each of the activities. Okay, so this is actually an extract or an excerpt. Okay, so you will not get this amount 110 because there are actually information for the operation activities that I have not included here. Okay, so this is only showing the part of how the investing activities and financing activities are reported, okay, in the statement of cash flow. Okay, then another item that can be reported is the non-cash transaction. So usually this is another section under the statement of cash flow. So this is only the reporting of investing and financing activities that do not affect cash. Okay, so it means that any investing or financing activities that involve, okay, the exchanges of debt. Okay, so it's a non-cash transaction. Okay, so you don't have to report it. You are only reporting it, just stating that this activities has happened, but it does not affect the cash part. Okay. So they are not reported in the body of the cash flow statement. They are reported under another section. Okay, just explaining of what has happened. Okay. 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 So this is how the non-cash transaction are reported under a different section. Okay, for example, okay, there is acquisition of building by issuing common stock. So this does not involve any cash transaction because this is an exchange of asset with equity. Okay, so here this is an exchange of asset with debt or long-term liability, and this is actually a payment of liability with an equity. Okay, it does not involve any movement of cash, so it's only reported, okay, under under section, okay, below the cash flow statement of the non-cash activities, non-cash investing and financing activities that has happened during the year.